In 2025, the relentless rise in the cost of living has placed unprecedented financial pressure on families across the United Kingdom, making every penny more critical than ever. From soaring energy bills to escalating grocery prices, households are grappling with tough choices to make ends meet. Amid this economic strain, a vital financial warning has emerged that could catch millions of unsuspecting savers off guard. If you've diligently tucked away £7,500 or more in a savings account, particularly in fixed-rate accounts offering attractive interest rates, you might be heading toward an unexpected tax bill from Revenue and Customs HMRC. What feels like savvy financial planning, securing your money in high-yield accounts to safeguard your future, could inadvertently trigger a hidden tax trap. This issue is not about tax evasion, but about understanding the rules to protect your hard-earned savings. So, why are thousands of everyday savers, who are simply trying to grow their wealth, suddenly at risk of being taxed? More importantly, what practical steps can you take to ensure your savings remain secure and your interest earnings aren't eroded by an unforeseen tax liability? At the core of this issue lies the Personal Savings Allowance (PSA), a tax rule that allows individuals to earn a certain amount of interest tax-free each year. For basic rate taxpayers who pay 20% income tax, this allowance is £1,000 per year. For higher rate taxpayers, taxed at 40%, the allowance drops to £500. Additional rate taxpayers, those in the highest income bracket, receive no allowance at all. These thresholds have remained unchanged for years, but the financial landscape has shifted dramatically. In the past, when interest rates were near zero, few savers earned enough interest to breach these limits. However, with interest rates climbing in 2025, savings accounts are finally offering meaningful returns, often 4.5% or higher on fixed-rate accounts. While this is welcome news for savers, it also means that more people are inadvertently crossing the PSA threshold, sometimes without realizing it until they receive a tax notice. The combination of higher interest rates and static tax allowances has turned what was once a niche concern into a widespread issue affecting millions of UK savers. To illustrate the problem, consider a practical example. Suppose you've saved £7,500 in a 3-year fixed-rate account paying 4.5% annual interest, with interest compounded over the term. By the end of the 3 years, your savings could generate approximately £1,160 in interest. For a basic rate taxpayer, this amount exceeds the £1,000 tax-free allowance, meaning the excess interest, £160, would be taxed at 20%, resulting in a £32 tax bill. For higher rate taxpayers, with only a £500 allowance, the taxable portion would be £660, leading to a £264 tax bill at 40%. The situation becomes even more complex if your savings account is structured to pay all interest at maturity, rather than monthly or annually. In such cases, HMRC treats the entire interest as earned in the year it's paid, even though it accrued over multiple years. This technical detail can lead to a larger than expected tax liability, catching savers off guard. Financial expert Laura Sutter, Director of Personal Finance at AJ Bell, has sounded the alarm on this issue, noting that many savers are unaware of how interest timing works. People are doing the right thing by locking their money into high-interest accounts, she explains, but the structure of these accounts can inadvertently trigger a tax bill. So, how can you protect your savings from this hidden tax trap? The first step is to understand when and how your account pays interest. Accounts that pay interest only at maturity can push you over the PSA threshold in a single tax year, amplifying your tax liability. To mitigate this, consider switching to a savings account that pays interest monthly or annually. By spreading interest payments across multiple tax years, you can stay within your tax-free allowance each year, significantly reducing or even eliminating the tax burden. This simple adjustment requires no additional investment, but can make a substantial difference in how much of your interest you keep. For example, if the £1,160 interest from the earlier scenario were paid annually over 3 years, roughly £387 per year, it would remain well below the £1,000 allowance for basic rate taxpayers, avoiding tax entirely. Another highly effective strategy is to leverage a fixed-rate individual savings account ISA. ISAs offer a powerful shield against taxation, as all interest earned within an ISA is completely tax-free, regardless of the amount or when it's paid. Whether your ISA pays interest monthly, annually, or at maturity, HMRC cannot touch it. In 2025, the annual ISA allowance is £20,000, allowing you to save a substantial amount tax-free. For serious savers, particularly those with £7,500 or more, transferring funds into a fixed-rate ISA is often a no-brainer. This approach is especially valuable in the current economic climate, where every pound of interest counts. ISAs not only protect your earnings from tax, but also provide peace of mind, allowing you to focus on growing your wealth without worrying about HMRC's reach. Financial advisors recommend reviewing your savings portfolio to ensure you're maximizing your ISA allowance each year. Why has this issue become so pressing in 2025? The answer lies in the rapid transformation of the financial environment. After years of ultra-low interest rates, where earning significant interest was nearly impossible, rates have climbed to levels not seen in over a decade. A few years ago, generating £1,000 in interest required a substantial savings balance, often tens of thousands of pounds. Today, with rates at 4.5% or higher, even modest savings of £7,500 can push you over the PSA limit. This shift has caught many savers unprepared, as the PSA thresholds have not been adjusted to reflect higher interest rates or inflation. As a result, what was once a rare scenario is now a common risk for anyone with a decent savings pot. The cost of living crisis adds further urgency, as families rely on their savings to buffer rising expenses. Losing even a small portion of interest to tax can feel like a significant setback when budgets are already stretched thin. To stay ahead, savers must adopt a proactive and strategic approach. Beyond adjusting interest payment schedules and using ISAs, consider diversifying your savings across different types of accounts. For instance, you could allocate a portion of your savings to premium bonds, which offer tax-free prizes instead of taxable interest. While the returns are based on luck, they provide a tax-efficient alternative for some savers. Additionally, if you have multiple savings accounts, keep track of the total interest they generate. It's easy to lose sight of cumulative interest, especially for higher-rate taxpayers with a £500 allowance that can be breached quickly. Using online calculators or consulting a financial advisor can help you estimate your interest earnings and plan accordingly. For those nearing or exceeding their PSA, spreading savings across accounts with different payment structures or prioritizing ISAs can optimize tax efficiency. The bottom line is clear. If you have £7,500 or more in savings, particularly in fixed-rate accounts, now is the time to act. Start by reviewing your account terms. Check when interest is paid and how much you're likely to earn. Use a simple calculator to estimate whether your interest will exceed your tax-free allowance in any given year. If it will, take steps to minimize your tax liability. Switch to accounts with monthly or annual interest payments, transfer funds to a fixed-rate ISA, or diversify your savings to include tax-free options like premium bonds. These actions aren't about dodging tax. They're about managing your money wisely to maximize your returns. In 2025, with inflation and living costs still biting, every pound of interest you preserve strengthens your financial security. Don't let an overlooked tax rule undermine your savings momentum. This is your financial wake-up call. The rules of the personal savings allowance haven't changed, but the economic reality has. Interest rates are up, savings are earning meaningful returns, and the tax thresholds haven't kept pace. By staying informed and making small, strategic adjustments, you can protect your savings from unnecessary tax bills. Take control of your finances today, review your accounts, plan tax efficiently, and ensure your hard-earned money works for you. In a year when financial resilience is paramount, these steps can make all the difference. Stay vigilant, stay strategic, and secure your financial future in 2025.